Hi, it's Jason Hull with Hull Financial Planning, and we're here with today's Personal Finance Frequently Asked Questions series. Today's question is, what is diversification? Why is it important? Well, as Don Quixote once said, "'Tis the part of wise man to keep himself today for tomorrow and not venture all his eggs in one basket." I can imagine him telling Sancho Panza this as he goes off tilting after another windmill. That is diversification. The actual definition is the diversification is the spreading out of money that you invest into many different investments. There are different classes of investments. You can invest in assets which give you a stream of income, like bonds, annuities, CDs. You can invest in assets that you hope will grow over time, such as growth stocks, or invest in assets that go up when the rest of the market goes down, like gold. The reason that you want to diversify your investments is that you subject yourself to less overall investment risk when you do so. So let's say, for example, that you invest all of your money into one stock, and then that company goes bankrupt and your stock is now worthless. You've just lost all of your money. However, if that stock was just one of many in your portfolio, then the negative impact won't be nearly as crippling. The impact of diversification itself decreases, though, as you add more assets. So diversifying from one stock to two stocks is a big impact, but diversifying from 100 investments to the 101st investment doesn't have that same impact. Studies have shown that the optimal diversification is achieved around 25 different investments. So the easiest way to achieve diversification is through mutual funds. The cost for an individual investor to achieve diversification through single stock purchases is high, so using a mutual fund solves this issue. It's also important not to fall for the thinking that, hey, if only I had invested in Apple at its IPO at the initial public offering, I'd be rich. You're falling for something called the availability bias. It's like looking at lottery advertisements and thinking that everyone's a winner rather than remembering all the people who bought lottery tickets and did not win. As always, past performance is no indicator of future returns, and investing in the market carries its own risk. So consult with your financial planner about how best to diversify your investment portfolio.